Buy and sell zones are probably one of the most useful concepts in trading, and they are also one of the easiest to get wrong. Most traders draw a box where price reacted before. They call it support, resistance, supply, demand, whatever. Then price comes back, they enter, and price slices straight through it. Here's the thing. A zone is not important because price touched it. A zone is important because one side took control from there and broke structure. That is the difference. So in this video, I will show you how to find the zones that actually matter, wait for confirmation, and then apply it on one full chart. In the previous video, we talked about market structure, who is attacking, who is defending, and which side is actually winning. This video is the next step. Market structure tells you direction. Zones tell you location. Confirmation tells you timing. If you mix those three together, trading becomes much cleaner. You're no longer buying a random line or selling a random level. You're waiting at a place where the market already showed strength. The framework is simple. First, check the higher time frame and identify the market condition. Second, find the side in control. Third, decide whether you are trading an origin zone or a retest zone and mark it correctly. Fourth, wait for price to return. Fifth, enter only after confirmation candle close and acceptable risk to reward. The first filter is not the zone. It is the environment around the zone. Before you mark any buy zone or sell zone, ask one question. What condition is the market in? Start with the higher time frame first. If you trade the 15-minute chart, check the 1-hour or 4-hour chart. If you trade the 1-hour chart, check the 4-hour or daily chart. A lower time frame zone that agrees with the higher time frame is usually cleaner. A zone against the higher time frame can still react, but it is fighting pressure from above or below, and if it sits directly inside a higher time frame opposing zone, treat it with caution. For practical trading, I divide the market into 4 conditions. 1. Clear uptrend. Buyers are breaking highs and defending higher lows. In this condition, you mainly look for buy zones. 2. Clear downtrend. Sellers are breaking lows and defending lower highs. In this condition, you mainly look for sell zones. 3. Clean range. Price moves between clear boundaries. Here, you can trade the edges if context supports it or wait for a breakout and retest. 4. Messy range. Price keeps sweeping highs and lows, candles overlap, long wicks appear everywhere, and no side is cleanly in control. If the market is messy, the best trade is often no trade. This one filter removes more bad trades than most entry techniques. Because when the environment is unclear, even a good-looking zone becomes dangerous. Once the environment is clear, we can ask the most important question. Where was control actually proven? Now here is where support and resistance becomes useful. A zone becomes valuable when it caused something meaningful to happen, not when price touched it, not when it looks neat, not because everyone can see it. A strong zone is a place where one side stepped in with enough power to break structure. And when I say meaningful structure, I mean a swing that is obvious when you zoom out, or the swing that created the most recent break of structure. If you have to search for it, it is probably internal noise. In an uptrend, a higher low only matters if it helps create a higher high. That means buyers defended that area, attacked from that area, and broke the previous high. In a downtrend, a lower high only matters if it helps create a lower low. That means sellers defended that area, attacked from that area, and broke the previous low. So we do not mark every small swing. We focus on the swings that actually change the chart. The best zones often come from the base before the impulse, not from random candles in the middle of the move. There are 2 zone types I want you to separate. An origin zone is the base before the displacement that caused structure to break. A retest zone is the broken support or resistance level that price returns to after a real body close breakout. Do not mix them. Origin zones come from the source of control. Retest zones come from the breakout level. Here is the practical drawing rule for origin zones. For a buy zone, look for the last small base or the last bearish candle before the bullish displacement that broke structure. A base is usually a few small or overlapping candles right before the strong move, not the entire pullback and not the whole rally. Draw the zone around that origin area, from the lowest wick to the highest candle body in that base. For a sell zone, flip it. Use the last small base or the last bullish candle before the bearish displacement that broke structure. Draw from the highest wick to the lowest candle body in that base. If the zone is too wide, do not force the trade. Drop to a lower time frame to refine it or wait for a cleaner zone. The zone is not strong because we drew it. It is strong because the market already proved something there. Now let's turn that into buy zones and sell zones. A strong buy zone is created when buyers step in with enough strength to break a meaningful swing high. Imagine price pulls back, forms a small base, and then launches upward with strong candles. If that move closes above a meaningful previous high, the origin of that move becomes a potential buy zone. Why? Because buyers did not just react there, they took control from there. When price returns to that area, we do not know for sure that buyers will defend it again. But we know this is a location worth watching. The sell zone is the same logic in reverse. A strong sell zone is created when sellers step in with enough strength to break a meaningful swing low. Price rallies into a base, sellers attack from that area, and the impulse closes below a meaningful previous low. That origin becomes a potential sell zone because sellers proved control from that area. Use this checklist. Does the higher time frame support this direction? What time frame is this zone coming from? Did the side in control create strong momentum? Did the move break structure? Is the zone too close to an opposing zone? Is there enough room to target the next area? If the answer is not clear, the zone is probably not clear either. But even a strong zone is only a location. It is not an entry by itself. This is the part that separates patient traders from emotional traders. When price returns to any zone, three things can happen. First, price respects the zone and reverses. This is the outcome everyone wants. Second, price breaks straight through the zone. The level that looked strong becomes useless. Third, price sweeps through the zone first, traps early traders, and then reverses. This is why blindly placing a limit order at every zone is dangerous. You are entering before the market tells you whether the same side is still defending the area. Limit entries can work, but they require very strong context and experience. For most traders, waiting for confirmation is safer. Confirmation will reduce the number of trades you take, but it can improve the quality of the trades you keep. So what does confirmation actually look like? I use a simple three-stage model. For a buy setup, confirmation starts before the bullish candle appears. Stage 1. Sellers weaken. You might see smaller bearish candles, long lower wicks, or slower momentum as price approaches the buy zone. The important idea is simple. Sellers are still pushing down, but they are not getting the same result anymore. Stage 2. Price enters a dispute phase. This can look like a small range, compression, or a few candles with bodies that get smaller. Buyers and sellers are fighting, but price has stopped falling cleanly. Stage 3. Buyers confirm control. That can be a strong bullish candle, a close above the small range, or a break of minor structure in the expected direction. But the candle must close. A candle that spikes above minor structure while it is still forming can still turn into a wick and trap you. For a sell setup, flip the logic. Buyers weaken, price stalls or compresses, then sellers confirm with a bearish break and candle close. Do not look for perfection. Markets are not perfect. More confirmation usually means a later entry but higher quality. Less confirmation means an earlier entry but higher risk. Once you understand this model, you are no longer trying to catch the exact bottom or top. You are waiting for the market to prove that the zone is being defended. Now let's connect this model to the two most common structures you will see on the chart. Now let's turn the theory into actual setups. The first setup is a clean range breakout and retest. Price moves sideways between a clear high and a clear low. Liquidity builds inside that range because buyers and sellers keep fighting around the same area. For a buy setup, price closes above the range high with a real candle body, not just a wick. A wick can be a trap. A body close shows stronger commitment. Then price returns to retest the old resistance. If buyers defend that area and confirmation appears, the The old resistance can become a buy zone. This is a retest zone, not an origin zone. The zone comes from the breakout level, but the entry rule is the same. Wait for price to return, then wait for confirmation to close. For a sell setup, price closes below the range low, retests the old support, and sellers confirm control. There are two important filters. Do not trade the breakout if price is breaking directly into a strong opposing zone, and do not trust a breakout that is only a wick with no body close. The retest should show rejection or confirmation, not just a touch. The second setup is for markets that are already moving, but where chasing is dangerous. Most traders lose because they buy the high or sell the low. They see price moving fast, they feel late, and they jump in right before the pullback. A better approach is to wait for price to pull back into a logical zone. In an uptrend, that zone might be the demand area that caused the last break of structure, or the old resistance that price broke and is now retesting. In a downtrend, it is the opposite. A supply area that caused a break of structure, or old support retesting as resistance. The pullback should not be random. It should return into a place where buyers or sellers previously proved control. Then you watch for the same three stages. Opposing side weakens, price compresses, dominant side confirms. Entry can come on the break of the confirmation candle high for buys, or the break of the confirmation candle low for sells. For buys, invalidation is usually below the zone low, or below the sweep low that formed during confirmation. For sells, invalidation is usually above the zone high or above the sweep high. If that stop makes the risk too large compared with the next target, skip the trade. A good zone with bad risk to reward is still a bad trade. There is one tool that can help judge whether the pullback is balanced, but only if you use it correctly. Fibonacci is useful, but only when it supports a trade idea that already makes sense. Fibonacci should not create the trade idea by itself. Draw it only on a clean impulse wave. For buys, draw from the swing low to the swing high. For sells, draw from the swing high to the swing low. The levels I care about most are the 0.5 and 0.618 area, because they often show a balanced pullback. But here is the key. If that area lines up with a real demand zone, broken resistance, or retest area, the zone becomes more interesting. If Fibonacci is floating in the middle of nowhere, ignore it. Fibonacci does not create the zone. It only adds confidence to a zone that already matters. Just as important as knowing what to trade is knowing what to avoid. But knowing what to trade is only half the skill. You also need to know what to avoid. A weak zone is usually more dangerous than no zone because it gives you false confidence. Avoid messy sideways markets where price keeps sweeping highs and lows. Avoid zones created by weak, wick-only breakouts. Avoid zones that have already been tested too many times. Avoid buying directly below a major sell zone. Avoid selling directly above a major buy zone. And avoid trades where the stop loss is large but the next target is close. Sometimes the zone is real, but the trade is still bad because there is no room to get paid. Professional trading is not about finding more trades. It is about filtering out the bad ones. If one major condition is missing, standing aside is not a mistake. It is part of the strategy. Now let's close the loop and apply the full framework on one chart. Now this is the chart example I promised at the beginning. At first glance, there is an obvious support level here. Many traders would mark it immediately and wait to buy. But when we read the structure, that zone did not prove control. Price reacted there, but the move from that area did not break a meaningful swing high. It was only a reaction, not a proven zone. Now look at this second area. Price pulled back, formed a base, then buyers stepped in with strong momentum and closed above the previous high. That is a break of structure. This area is different because buyers proved control from here. So the zone is not the entire rally. The zone is the origin, the base, before the displacement. We draw it around that base, then wait for price to come back. Now we wait. Price returns to the zone. We do not enter blindly. First, sellers start to weaken. The candles become smaller and lower wicks appear. Second, price compresses. It stops falling cleanly. Third, buyers break minor structure with a strong candle close. Now the trade idea is complete. Higher time frame context does not fight the trade. Market condition supports the direction. The zone caused a real break of structure. Price returned cleanly, confirmation appeared, and risk to reward is acceptable. Entry goes after confirmation. For a buy, stop loss goes below the zone or below the sweep low. For a sell, it goes above the zone or above the sweep high. Target goes at the next clean opposing zone, and if confirmation never appears, there is no trade. Missing a move is better than forcing a low-quality setup. Here is the final checklist. First, context. What does the higher time frame say? What market condition are we in? Who is in control? Is this an origin zone or a retest zone? Did this zone cause a real break of structure, or did it come from a valid breakout level? Second, execution. Is price returning cleanly? Is the opposing side weakening? Do we have confirmation with candle close? Is the stop loss placed beyond real invalidation? Is there enough room for at least 1 to 1.5 or 1 to 2 risk to reward? And finally, is there one major reason to skip? If there is, skip. Do not trade every support and resistance level. Trade the zones where control was proven, not the zones that only look obvious. If this video helped you, like the video and subscribe. Thanks for watching.